A stock screener is the cheat code to finding good stocks because it lets you sort through thousands instantly based on winning characteristics, but you need to set it up correctly. The 5 screener settings we're going over in this video will give you a list of high potential investment ideas, even if you have no idea where to start. Inside Webull, select the Markets tab at the bottom, then click the screener icon in the top right. Hit create new screener, and everything you see on this page you can customize. Now watch what happens to the number at the bottom of the screen next to the view result button as we set up each of the 5 screeners. That'll create a list of super strong stocks you can use as possible investments. Now Webull often offers cash bonuses or free stock for signing up, which is required to use the screener anyway, so don't miss out on free value if you haven't signed up yet. The link in the comment section below shows you what you'll currently get and a way to sign up if you haven't already. Okay, so for the first filter, we want to find companies with a proven ability to make money. Scroll down to total revenue and choose greater than $100 million. This automatically sorts out tiny, unproven companies for those driving real sales. You'll notice that the number at the bottom dropped from nearly 6,000 to just over 3,100, and we still have 4 filters to bring this number down even more. Now, revenue alone is useless if the company can't turn sales into profit, and that's why the second filter is operating income. This is the profit after normal business costs like wages, rent, and manufacturing costs, but before taxes and interest. Under operating income, go ahead and select greater than 100 million and hit done. Now, we sorted for companies that both sell a lot and actually make money while doing it. At this point, the stocks in this list can still be a bad investment if there's high levels of debts, and that's why the third filter you want to use is called debt to asset. This percentage shows how much debt a company has compared to its total assets. The higher this number, the more the company relies on debt, which means more risk. Choose less than 70% here. Now, some sectors naturally rely on debt because a lot of money is required to operate. Think about Verizon, AT&T, or other telecommunication companies which require a lot of money for infrastructure like cell towers. But still, a debt to asset ratio of 100%, for example, means a company has as much debt as they do assets, and this is a red flag. Now that we've filtered for stocks with a reasonable amount of debt, we want to see if the business produces real, usable cash, not just profits on paper. This is how companies can pay out shareholders in the form of dividends or reinvest to make even more money. And that's why the fourth filter is cash flow from operating activities. This shows how much cash the core business brings in after operating expenses. A lot of companies actually have negative operating cash flow, meaning the business is burning through cash. So you'll want to set this to greater than 0 to filter for companies that actually generate cash they can use to reinvest, pay dividends, or pay down debt. But we're still missing one key insight, and that's how well management can turn investor money, like yours or mine, into profit. And that's why the fifth filter is ROE, which stands for return on equity. By selecting greater than 10% here, this sorts for stocks generating a solid return on the capital shareholders have put in. With those 5 filters, the number of stocks to look through as possible investments have dropped from nearly 6,000 to just over 120, and this is exactly what we want. A short list of companies that meet a minimum financial baseline, showing that they're capable of driving revenue, profit, positive cash flow, have a reasonable amount of debt, and can efficiently turn investor money into profits. But stopping here and buying a random stock from this list can still be dangerous because we don't have a full picture of the stock's financial situation. While these metrics might look good on the surface, the real way to tell if a stock may be a winner lies in the trend. For example, a stock might have a big profit, but if it's been declining year over year, that's a bad sign. So once you have your smaller list, like these 120 stocks, you can go through a few of them and check the following. Is revenue trending up or down over time? Is operating income growing or slowing down? Is debt getting paid down or is it increasing? And is cash flow increasing, going down, or remaining pretty stable? If these numbers are moving in the right direction and the company looks stronger than others in the same industry, that's when you've found a stock likely worth investing in. For a full walkthrough of the Webull features you can use to make even better trades, you'll want to watch this Webull tutorial for complete beginners video.